Welcome to simodefafinance, the YouTube channel where we explain finance in quick and simple bites. Today we are diving into the 2008 financial crisis, an event that rocked the world and whose effects are still felt today. But what exactly happened? Let's break it down together. Imagine a world where almost overnight the financial systems we rely on crumble, jobs disappear, and the economy spirals into chaos.
You're the best partner I could imagine.
This isn't a plot from a movie but the reality of a 2008 financial crisis. We'll explore what caused it, how it unfolded, and the lasting impact it has had on our world. So grab a cup of coffee, sit back, and let's unravel the story of the Great Recession. The 2008 crisis, also known as the Great Recession, began in the United States and then spread worldwide. It was triggered by the collapse of the housing market and subprime mortgages. But what are subprime mortgages? Imagine an auction where anyone can bid on a house, even if they have no money. Sounds crazy, right? Well, that's exactly what happened. During the early 2000s, housing prices were soaring. Everyone wanted a piece of the American dream, and banks were more than willing to help. They started offering loans to people with low incomes and poor credit scores. These were the subprime mortgages. To make it easier, let's say you give a loan to someone who has a history of not paying back. Risky, isn't it? But banks didn't stop there. They bundled these risky loans into investments called mortgage-backed securities and sold them as safe bets. When homeowners defaulted on their loans, these investments turned toxic. A deep dive into subprime mortgages. Let's dig a little deeper into subprime mortgages and why they were so disastrous. Subprime loans were given to borrowers who were considered high risk due to their low credit scores or unstable financial histories. Banks were motivated to issue these loans because they could charge higher interest rates, making them seem more profitable despite the risks. However, the real issue arose when these subprime loans were bundled into mortgage-backed securities, MBS, and sold to investors. These securities were often given high ratings by credit rating agencies, despite being composed of risky loans. To further complicate matters, financial institutions created even more complex financial products like collateralized debt obligations, CDOs, which were essentially bundles of these already risky MBS. Investors around the world bought these products, believing they were safe investments. When homeowners began defaulting on their loans, the value of these securities plummeted, leading to massive losses for investors and financial institutions alike. The impact on financial institutions. This led to massive losses for financial institutions that held these securities. Bear Stearns was one of the first to collapse, but the tipping point was the fall of Lehman Brothers in September 2008. Lehman Brothers, a titan in the investment banking world, filed for bankruptcy, sending shockwaves through the global financial markets. The collapse of Lehman Brothers was particularly significant because it highlighted the interconnectedness of global financial markets. When Lehman went under, it wasn't just an isolated incident. It caused panic and uncertainty across the entire financial system. Stock markets plummeted, credit froze, and other banks teetered on the brink of collapse. The interbank lending market dried up, making it difficult for banks to obtain the short-term funding needed to operate. It was a domino effect of failures, with financial institutions around the world feeling the impact. Lehman Brothers collapse. The fall of Lehman Brothers is often seen as the climax of the financial crisis. It marked the moment when the true extent of the crisis became apparent to everyone. Suddenly, it wasn't just a few banks in trouble, it was a systematic problem that threatened the entire global economy. The immediate aftermath saw stock markets around the world suffer dramatic declines, wiping out trillions of dollars in value. Confidence in the financial system was shattered, and the fear of a complete economic collapse became very real. Government interventions. Governments around the world had to step in to prevent a total financial meltdown. In the US, the government launched the Troubled Asset Relief Program, a $700 billion bailout to stabilize the banking sector. Central banks slashed interest rates and pumped liquidity into the financial system. These measures were aimed at restoring confidence and ensuring banks could continue to lend. This was a controversial program, with many criticizing it as a bailout for reckless bankers at the expense of taxpayers. However, it was deemed necessary to prevent a complete collapse of the financial system. In addition to TARP, the Federal Reserve implemented unprecedented measures, such as lowering interest rates to near zero and purchasing large quantities of government and mortgage-backed securities to provide liquidity to the markets. Similar actions were taken by the central banks around the world, highlighting the coordinated global effort to address the crisis. The global impact. The crisis didn't just affect the US. Europe, Asia, and other parts of the world felt the tremors. Many countries faced severe recessions, with rising unemployment and plummeting GDP. Countries like Greece, Ireland, and Spain were hit particularly hard, leading to a sovereign debt crisis in Europe. The global nature of the crisis meant that no economy was immune. In Europe, the crisis exacerbated existing fiscal problems in countries like Greece, leading to a sovereign debt crisis that required international bailouts. Unemployment soared, particularly among young people, and austerity measures implemented to address budget deficits led to widespread social unrest. In developing countries, the crisis led to a sharp decline in exports and foreign investment, further deepening economic woes. The long-term effects. The 2008 crisis had long-lasting effects. It reshaped the financial industry, leading to stricter regulations and oversight. The Dodd-Frank Act in the US, for instance, aimed to reduce risks in the financial system. People became more cautious about borrowing and lending, and the trust in financial institutions was significantly eroded. The Dodd-Frank Act introduced a range of measures designed to increase transparency and reduce systemic risk in the financial system. This included stricter capital requirements for banks, enhanced oversight of financial institutions deemed too big to fail, and the creation of the Consumer Financial Protection Bureau, CFPB, to protect consumers from predatory lending practices. Despite these reforms, the crisis left a lasting legacy of mistrust in financial institutions and raised questions about the effectiveness of regulation in preventing future crises. Lessons learned. The crisis taught us several important lessons. The dangers of excessive risk-taking and lack of regulation, the interconnectedness of global financial systems, and the importance of transparency and accountability in the banking sector. It also underscored the need for better consumer protection and more robust financial education. One of the key takeaways from the crisis is the importance of understanding and managing risk. The excessive risk-taking by banks and other financial institutions driven by short-term profit motives was a major factor in the crisis. The lack of effective regulation and oversight allowed these risks to accumulate and ultimately trigger a systemic collapse. The crisis also highlighted the interconnectedness of global financial markets, showing how problems in one part of the world can quickly spread and impact the entire global economy. Finally, it underscored the need for better financial education, both for consumers and policymakers, to ensure that the lessons of the crisis are not forgotten. Conclusion. Thanks for watching our video on the 2008 financial crisis. If you found this explanation helpful, give us a thumbs up and subscribe to the channel for more financial insights. Comment below with any topics you'd like us to cover next. See you next time.